Today's focus: tariffs trigger selling pressure, liquidity continues to tighten, how should Bitcoin break through? Major players are starting to diverge in their strategies. USDT is flowing out of the crypto market in large volumes. Who is shaping the new landscape of the cryptocurrency market? Could it be AI? February 24th, Tuesday. This is BTV Chinese channel Blockchain Fusion. I'm Michael. Let's first take a look at the most important data from the past 24 hours in the crypto world. As soon as Trump raised tariffs, Bitcoin started to fall. But is that really what the on-chain data shows? Tariffs are actually just a trigger. The real issue is that short-term positions in the market are becoming increasingly unstable. Let's look at the profit ratio of short-term holders, which is the STHSOPR. This indicator is very clear. Last April, when the 60% tariff was announced, this indicator dropped below 1. Short-term holders started selling at a loss, and Bitcoin was pushed down from $96,000 to around $85,000. Then, in October of the same year, when the 100% tariff was announced, Bitcoin happened to surge to a high of $126,000. This indicator was still around 1, meaning holders were still in profit. So looking at it now, that high point became the best opportunity for everyone to sell. After that, Bitcoin kept falling for several months. Then this February, when the 15% tariff package was implemented, the indicator dropped below 1 again, and short-term holders started selling at a loss, so that pressure came back again. The tariffs are really just a way to predict how well the Bitcoin market can withstand pressure, and are not actually the real reason for Bitcoin's price fluctuations. The real reason for the market crash is the short-term holders who panic and start selling at the slightest sign of trouble, while the positions of long-term holders remain completely unchanged. So remember this rule: when the indicator drops below 1, it means people are selling at a loss, and when the indicator is around 1 and the price is still high, that's the best signal for everyone to sell before a major drop. On Monday, the price of Bitcoin dropped directly to around $64,000. If you look into the on-chain data, you'll find that the Coinbase Premium Index had just started to recover a bit over the weekend, but as soon as the 30-week moving average crossed above the zero line, it couldn't hold, and now it's turned back down again. What does this indicate? It clearly shows that during US stock market hours, no one is willing to make large purchases. Demand in the US spot market is currently very weak, and the incoming funds are simply not enough to support Bitcoin's price moving upward. You have to understand, if this moving average can stay steadily above the zero line, what does that mean? It means that US capital is leading the buying spree. But looking at it this time, it was just a false breakout. The drop back down is basically telling everyone that there is no liquidity in the US market right now. Moreover, if we look at the short-term cycle, when this index gets stuck near the zero line and doesn't move, it often happens before the price of Bitcoin drops, so you can use this indicator as an early warning signal before a downturn. Ever since the crypto market peaked last October, this round of the market has been grinding sideways and adjusting. The most critical issue right now is that there's hardly any liquidity in the market. Christopher Waller, an official from the Federal Reserve, recently said that the employment index for February was particularly strong, so it's highly unlikely that interest rates will be cut. Rates will have to stay high, and with such high interest rates in place, no one dares to put their money into the crypto market anymore. Instead, they're turning to buy US stocks and gold. On-chain data has confirmed this as well. Let's look at Binance. The reserves of ERC20 stablecoins have been declining since mid-November, dropping from $50.9 billion all the way down to $41.4 billion, a decrease of nearly $10 billion, which is about an 18.6% drop. The current amount has already returned to the low point of October 2024. So you have to understand, stablecoins are the hard currency of the crypto market. The fewer stablecoin reserves there are, the more it shows that people don't dare to increase their positions, leverage is going down, and basically no one is willing to come in and buy coins. So Binance's stablecoin reserves account for 64% of the total trading volume across the entire network. So as you can see, even the largest liquidity pool is shrinking. This is a clear sign of weakness. If we want the market to stabilize, the key is to bring stablecoins back into the crypto space. Only by reversing the trend of increasingly scarce capital can there be a chance for prices to rise. Alright, please like this video and turn on the notification bell. We're here to help you sort through the crypto news that's closest to your wallet in the past 24 hours. The New Year holiday is over, and this is the second day back at work. Let's take a look. Every year after the holidays, there's a 3-day dip. Is this year's Spring Festival market still following the pattern of low participation and high volatility? In mid-February, Bitcoin rebounded to around $70,000, but the excitement didn't last long and it quickly fell back to reality. By late in the month, the combined effect of deleveraging and selling pressure caused volatility to spike, and within just a few days, Bitcoin dropped to the $60,000 range. Although there was a slight recovery afterward, the overall trend remained weak. On the charts, the bulls started to pull back. Short-term funds were busy reducing risk and controlling positions, and the bearish trend became very active. However, if we look at the on-chain data, long-term holders haven't sold off. There hasn't been any large-scale exit. The new year is over, the red envelopes have all been opened, but on the first day back to work, Bitcoin didn't hand out any dividends, not a single red envelope. Trading volume has shrunk, leverage has decreased, and the discussion forums have gotten a lot quieter. So now, the issue everyone in the crypto space is facing is whether this is a matter of choosing between bullish and bearish positions, a divergence in direction, or if a mature ecosystem is beginning to establish a rational division of roles. Strategy has once again increased its position to average down, buying 592 more bitcoins, bringing its total holdings to 717,722 coins, with an unrealized loss of about $7.9 billion on the books. Founder Michael Saylor stated that although the current market environment is somewhat bearish, the cyclical foundation is more stable than before, and he reiterated his long-term optimism about Bitcoin's potential for value appreciation.
I think Michael Saylor always says, sell a kidney, buy Bitcoin, right? And I think he's, I know obviously he jokes when he says that, but he's right. Buy it, hold it, and I think you're going to do extremely well. He's definitely not joking. Actually, he sold one of his kidneys, I'm pretty sure, so.
Meanwhile, the Ethereum camp is taking a different approach. Recently, Vitalik Buterin sold about $8 million worth of ETH in batches through decentralized exchanges and stated that Ethereum will enter a 5-year period of moderate tightening, with funds to be used for underlying security, scalability, and long-term infrastructure development. On one hand, this reflects a contrarian strategy of increasing positions, while on the other, it focuses on reallocating resources. If you saw our weekly review yesterday, then you would know that we still aren't optimistic about the market outlook. We also provided a specific price indicator for when to start buying gradually, as prices fall. We hope this will be helpful for your trading. Of course, during this round of decline, there are two completely different approaches. Some people keep buying as prices fall, increasing their positions the more the market drops, viewing this downturn or correction as a continuation of their long-term strategy. On the other hand, some have started to sell all their Bitcoin holdings and go all in on the AI sector. What we see with Bitcoin and Ethereum is not simply a disagreement between bulls and bears. Rather, it is two mature ecosystems responding differently to their surrounding environment. One side emphasizes the scarcity of resource-based assets, while the other focuses on advancing underlying efficiency and the evolution of security. Yesterday, we announced to everyone a new round of upgrades for Ethereum. After the upgrade, Ethereum Layer 1 will start collecting fees from Layer 2. In the future, prices will achieve true value capture and price support. But what truly determines who will take the next big step forward is often the capital allocation and system restructuring happening right now, which are not easily noticed by most people. How will AI impact the crypto world? In the future, we will help everyone break it down bit by bit. At present, the impact of AI, triggered by open cloud on technical positions, many entrepreneurial roles or analytical jobs, is self-evident. Many heads of AI positions have left behind very emotional resignation letters as they depart from their posts, because they feel that once AI enters recursive iteration, it's only a matter of time before their positions are replaced. AI is smarter than they are, learns faster, and can work 24 hours a day without rest. Even without light, it can still function. So how will the crypto world be impacted by AI? Will the price of Bitcoin become more resilient with the arrival of AI, or will it become more fragile? Right now, it's hard to say what the answer is, but we'll be closely monitoring every development in AI for everyone, and our channel has also started training our own lobster. Of course, when it comes to this round of Bitcoin's pullback, we still need to look for answers from past experience. Let's first look at the 2022 Bitcoin downturn, when the lowest point dropped to around $16,000. On the surface, the price had already collapsed, liquidity was receding, stablecoins were being redeemed, leverage was being wiped out, and capital was flowing out. What's happening now is exactly the same as in 2022, but what we need to pay attention to is not how wildly the price rises or falls, but rather how much ammunition is left in the market when it crashes. That's why lately, signals related to liquidity have once again become a frequent topic among people in the crypto community.
The latest on-chain statistics show that over the past 60 days, USDT's market cap has cumulatively decreased by more than $3 billion. And recently, there have been 3 separate days with net outflows exceeding $1 billion each. Looking at historical cycles, this kind of short-term concentrated market cap contraction is not a frequent occurrence. Changes in stablecoin supply are often used as an auxiliary indicator to gauge the state of market liquidity. Market cap expansion is usually accompanied by capital inflows and increased trading activity, while a decline in market cap corresponds to increased redemptions and a temporary contraction in liquidity.
So rather than trying to predict when the post-spring festival market will take off, it's better for us to calmly observe how things unfold under this high-pressure environment. The old rule of the market is actually very simple. Only when money stops continuously withdrawing and prices stop easily hitting new lows can the structure gradually shift into an upward trend. And when liquidity is compressed to the extreme, what usually happens first is the unwinding of leverage, increased volatility, and a cooling of sentiment rather than an immediate market rebound. What everyone should really focus their attention on is whether the stablecoin liquidity level is still continuing to shrink. After all, in the crypto market, capital flows often reveal changes in sentiment earlier than prices do. The trillion-dollar AI payments sector has begun a covert battle of escalation. What butterfly effects will this transformation bring? On one hand, legislation, on the other, risk prevention. Can South Korea really figure out stablecoins? Alright, just as everyone is considering how open cloud will impact their jobs, have you noticed that ChatGPT, Google, and Microsoft have already started an intense battle in the payments sector, a close quarters fight? On the surface, it looks like a competition of features, but at its core, it's about how the entry point for transactions is shifting. Users no longer need to go to a website or an app. Instead, AI directly handles the search, decision-making, and payment. And it's worth noting that cryptocurrencies have not been excluded from payments. On the contrary, stablecoins and blockchain have become part of the core structural layer of crypto or AI payments.
In 6 months, AI payments have gone from concept to reality. ChatGPT, Google, and Microsoft have added shopping and checkout to their chatbots. Behind this functional evolution by last September, the industry landscape was gradually becoming clearer. Google, together with more than 60 institutions including MasterCard, PayPal, and American Express, released the AI Agent Payment Protocol. Stripe and OpenAI launched the ACP protocol and began ecosystem testing. As AI agents participate in decision-making and execution, AI payments are beginning to be embedded into real transaction systems.
Well-known respected tech CEO Dario Amodei, who heads a cutting-edge AI company called Anthropic, is raising alarms tonight about AI's potential impact on employment that could soon be felt. Well, he says AI can lead to incredible advancements like medical breakthroughs and boost the economy. He believes it could also lead to half of entry-level white-collar jobs disappearing and 10 to 20% unemployment.
In 2024, the total global on-chain stablecoin transfer volume reached $15.6 trillion, with transaction volume approaching the annual processing capacity of Visa. The use cases for stablecoins continue to expand into cross-border settlements, transaction clearing, and institutional payments. USDC has long maintained a leading market share, with its issuer circle upholding reserve asset disclosures and regular audit mechanisms. The reserve structure is primarily composed of cash and short-term U.S. Treasury bonds. As on-chain transaction volumes grow, the frequency and proportion of stablecoin usage within the digital asset settlement system continue to rise.
So, if AI steps into the entry point of trading and starts to become part of the payment pathway, I believe the settlement layer for funds will also begin to be rewritten. So, what it changes is not just the products, but the entire set of financial rules of the game will be transformed. In the past, people clicked buttons and looked at interfaces. Now, AI agents are granted permissions and run protocols, and transactions are automatically completed in the background. Therefore, it is foreseeable that the scale of on-chain settlements will continue to grow in the future, and the presence of stablecoins and blockchains will keep rising. Only this time, the speed will be many times faster than in the traditional financial era. Let's take this conclusion and experience one step further. If stablecoins are truly inseparable from the fiat currency system, then are we still only discussing technical issues? Instead, the real questions become, where do financial security and the boundaries of new institutional frameworks actually lie? So, in South Korea, which is a market at the forefront of trading and exceptionally active in transactions, the discussion around a Korean won stablecoin is nothing new. The real sticking point for a Korean won stablecoin is precisely how its issuance mechanism and regulatory pathway should be structured.
We are working on the stablecoin bill by establishing a dedicated task force through extensive discussions. Significant progress has been made in solidifying the direction of the legislation. We anticipate that the bill will be formally introduced sometime next week.
In its policy report submitted to the National Assembly, the Bank of Korea gave a higher-level definition to the institutional nature of the Korean won stablecoin, regarding it as a quasi-currency substitute tool, and emphasized that its impact has already extended beyond the scope of ordinary digital assets. The core focus of the report lies in potential issues related to monetary policy transmission, capital flow management, and the adaptation of the financial stability framework. Policy discussions are ongoing regarding the qualifications of issuers, regulatory boundaries, and decision-making within the banking system. The legislative process and timeline have undergone multiple adjustments, and a final implementation schedule has yet to be determined.
So right now, South Korea is stuck in the middle. On one hand, they're worried that if stablecoins grow too large, they could affect the deposit structure and capital flows, making policy transmission extremely difficult. On the other hand, they don't want to miss out on the dividends of the entire digital asset sector. But now, with the arrival of AI agents are going to change the entire legislative pace. If you're still hesitating, wanting everything at once, AI will force you to go from being riddled with problems to just getting something done first in the short term. So AI will become a highly uncertain factor in the future of the crypto world. Will it be an inert element or a reactive one? How it will change the crypto world remains to be seen. And our daily report will always keep an eye on the latest variables that can most affect the flow of money in our wallets. All right, let's look at the news flash.
AI agents have messed up again. One misheard command and $250,000 worth of crypto was transferred to the wrong place, causing an instant uproar in the community. People are starting to re-examine whether it's really reliable to let AI manage money. Trump has once again made a statement. Even if emergency tariffs are blocked by the Supreme Court, if anyone tries to play games or strategize with trade agreements, the US still has backup plans. Tariffs can be increased further, and there might even be additional entry fees. Precious metals have cooled off a bit today. Gold failed to hold above $5,170, and silver also slipped below $86. The bullish risk-averse sentiment has temporarily hit the brakes. Musk's X is once again in the spotlight, with rumors swirling about entering the crypto trading space. Although there's been no official confirmation, the market is already buzzing. Everyone's watching and waiting for the next move while speculating. As soon as there was an official update, BN Alpha immediately brought Amazon, Meta, Apple, Circle, and Google all on-chain. With their code unveiled in unison, traditional giants are collectively making their token debut.
Has anyone else noticed how the Spring Festival holiday disappeared in the blink of an eye, and now our alarm clocks have taken control of our lives again? Back at our desks, our souls still linger on the festive stage. Fingers tap keyboards, but minds track the K-Line's moves. Elevator talk is just back already. Our holiday routine was a bull market. Late nights were easy, but back at work, it's a correction. Early mornings hurt. The most painful part is that both our waistbands and our bank balances are tightening at the same time. The most real thing is that our weight and our deadlines are racing toward each other. Now that the new year is over, our wallets have entered a tightening cycle, and we workers are back on the never-ending contract. And there's one saying that's even more sobering. Holidays are for recharging our happiness, while returning to work is about facing reality. Let's take a deep breath and open up our to-do lists, because life will keep pushing us to close deals. After all, KPIs never take a holiday. All right, that's all for today's program. If you find our channel valuable, please like and share it. Here you'll find all of our membership benefits. We hope you'll become a member so we can hustle together and gradually become wealthier. See you tomorrow.